Let's explore what really happens in markets when central banks cut interest rates. Rate cuts connect to bull markets, uncertainty, and investor expectations in surprisingly complex ways. Here's the key insight. Rate cuts don't always mean instant bull markets. Welcome to Money Mastery, your guide to financial freedom and smart wealth building. Central banks directly control interest rates through their monetary policy decisions. When rates drop, the effects ripple across stock markets, bond prices, and overall economic growth. What investors expect often contradicts what actually unfolds in the markets. The journey starts with the rate cut announcement, triggers immediate market reactions, reveals itself through economic data, and eventually settles into a long-term trend. Rate cuts happen when central banks lower interest rates to stimulate a slowing economy. But do they really fuel market rallies? When rates drop, loans and mortgages become cheaper, encouraging companies and consumers to borrow more freely. This increased borrowing leads to more spending, which theoretically should spark market growth and economic momentum. On paper, it sounds like rocket fuel for markets, but history tells a very different story. Let's look at times when rate cuts actually coincided with major market crashes. Aggressive rate cuts often signal that something fundamental is already breaking in the economy. The dot-com bubble burst in 2001, followed by rate cuts that helped recovery only gradually over time. Similarly, the 2008 housing crisis triggered aggressive cuts, but markets recovered slowly, not immediately. But rate cuts don't always lead to crashes. Sometimes they genuinely boost markets. In healthier periods, rate cuts increase liquidity and confidence, encouraging investors to take more risks. Tech stocks, housing markets, and consumer spending all tend to strengthen when conditions are favorable. So what signals actually matter more than the rate cuts themselves? Earnings growth, credit stress, and inflation trends all point toward where markets are really headed. The surrounding economic context matters far more than the rate cuts alone. When earnings are rising, markets typically climb as investor confidence and outlook improve. Bank stress or major defaults directly signal potential trouble ahead for markets. If inflation stays sticky, markets fear the central bank may need to hike rates again. High liquidity conditions provide strong support for stocks by increasing available capital. Different sectors respond very differently to rate cuts depending on economic conditions. Tech, small caps, consumer discretionary, and real estate typically benefit most when cuts happen in healthy economies. Utilities, healthcare, and consumer staples become more defensive choices when cuts signal crisis conditions. Instead of trying to predict outcomes, smart investors build a disciplined framework. That framework includes staying diversified, managing risk carefully, scaling positions gradually, and watching earnings over headlines. All markets reward patience, not panic buying. So what's the real takeaway about rate cuts and market performance? Rate cuts don't create magic. They simply create conditions that shape the market environment. Disciplined investors take advantage of conditions, not headlines. If this helped you see the truth behind the hype, hit like and subscribe. Next, we'll talk about which indicators tell you a bull market is real. Thank you for watching, and I'll meet you in the next video.